So today we're going to finish up Fool's Gold. So this is part three. And if you remember back in 2008, that's when things started to unravel. And there were significant mortgage defaults in the subprime market. And so the CDOs that were built on mortgages from subprime lenders, and remember subprime are lenders who couldn't get the normal interest rate. These were lenders who didn't have significant money to put down. They had otherwise bad credit scores, didn't have employment history for a very long period of time, and consequently, if they wanted to get a mortgage, they had to pay a higher interest rate. And because they didn't have much equity down and not a great credit history, they were called subprime mortgagees. So the CDOs that were made of subprime loans were the ones that had significant defaults in them, as you might expect. And because during 2007 and the run up to 2008, a lot of these CDOs were made up of subprime loans. And the reason these subprime loans were really attractive is because these mortgagees were paying a higher than normal interest rate. And to insure those loans, they were getting a higher fee premium. And so the bonds that were used as collateral to insure these subprime loans were very high yield bonds. And the rating agencies, as you remember, they were still rating these bonds, at least the senior tranches, as AAA rated bonds, because the folks at the rating agencies were under the same assumptions that they'd always been, that people weren't going to default on their mortgages. They might default on their credit cards, they might default on their auto loans, but they're not going to default on their mortgages for two reasons. One is they need a place to live, and two, the assumption was that mortgage rates always go up. So there'd be no reason to default on a loan, even if you couldn't pay it, because the house, if you've held it for any significant period of time, the house is going to go up in value. So you could just sell the house and keep your equity in the house and then just pay off the mortgage. So the assumption was that people weren't going to default en masse because they could just sell the house or they could refinance. And so if this assumption that real estate prices never go down but always go up is valid, then the rating agencies could make that assumption and therefore rate these bonds that were insuring subprime loans as AAA rated, even though the mortgages themselves that were in these bonds, or that the bonds were collateral for these mortgages, even though these mortgages were not necessarily AAA mortgages, they thought that if they were diversified enough, so if you took mortgages from Austin, Texas, and Fort Lauderdale, Florida, and Eugene, Oregon, so they weren't all in one location, that sure, there might be one or two people who default, but in general, nobody's really going to default because they're going to ultimately have equity in their home as home prices rise. And they'd seen significant rise in home prices over the last decade, so they thought, and we had never seen a real estate market crash like we'd seen a stock market crash. So the thought of that happening was basically nil. So these rating agencies were able to rate these bonds that they were using as collaterals for these mortgages as AAA because they just thought, even though these are subprime, they're not going to default. We're going to diversify the loan portfolio, so there's going to be loans from all over the country. So yeah, one or two people might default, but in general, these bonds are safe investments. But running up to 2008, a lot of these mortgage holders started to default on their loans, and it was precisely because they didn't have any equity in the home, and there was no cost to them to walk away from it and turn it back over to the bank. And home prices sort of inexplicably stopped rising. And so that gave a lot of these subprime mortgagees who didn't have any equity in the home, they didn't have any reason then to hold on to the mortgage and just let it go to the bank. So a lot of these mortgages that these banks were buying, these investment banks were buying up, were starting to default now. And Bear Stearns, that sort of kicked things off in this crisis, in that they had a lot of these mortgages on their books, and they they had what the book describes a maturity mismatch. So they were borrowing funds, like on the commercial paper market and the repo market. So they were borrowing funds short term, for 30, 60 days, and they were using that money that they were borrowing to buy 30-year mortgages. And they always thought that money would be available to them to borrow, anytime they wanted, because they were a safe investment bank without a history of trouble. But a couple of hedge funds related to Bear Stearns ran into trouble, and people started getting nervous because they realized that Bear Stearns had a lot of these subprime mortgages on their books. And so what happened was Bear Stearns stopped being able to borrow money. So like in the commercial paper market, these are people like big corporations. When they had excess cash, they would loan it for 30 or 60 days out in commercial paper, sort of like buying a certificate of deposit. And because they knew they would need it, 30 or 60 days later, but they wanted to get some type of return on it. So they tried to put it in nice, safe investments for 30, 60 days. And traditionally, they felt Bear Stearns and the investment banks, because these were short-term loans for quality from quality banks, that loaning them money for a short period of time was a good investment, and corporations were willing to do that. But once Bear became troubled, and people started reading in the paper and reading the news that a lot of these subprime mortgages were starting to default, people started thinking, well, I think Bear has a significant portion of those subprime loans, and we've already seen some hedge funds that Bear started start to have significant problems for precisely those same reasons. So people started getting nervous, and they weren't anxious to loan Bear any short-term money. Now, Bear had a lot of assets on their books. They had a lot of loans that were mortgages, that were 30-year mortgages. But if those mortgagees aren't going to pay you, for the next 30 years, and you need money 30 or 60 days from now, then that's where the maturity mismatch comes in. And so Bear needed to raise money to pay back some of these loans, these 30 and 60-day loans that they had. But because they invested it in mortgages, they couldn't turn around and sell those mortgages because a lot of them were subprime, and there wasn't really a market for those mortgages because people were nervous. So they couldn't sell their mortgages to raise money, and they didn't have any way to turn around and pay back these short-term lenders. And so they went into full crisis mode, and that's when, in March of 2008, is when the word got to the Fed in New York, to Timothy Geithner, that Bear was in trouble. And so what they were hoping to do was to find a bank who could buy Bear Stearns, who could buy their assets, at a fire sale price, but buy it nonetheless, and then be able to pay back their loans that were coming due. They didn't want to find out, all of a sudden that Bear had to default on their loans. That might cause panic throughout the world financial markets, because like Asia, for example, had loaned a lot of money to Bear and other U.S. investment banks, and if they find out that one investment bank's in trouble, then they might assume that all of them are in trouble, or at least a lot of them are in trouble, and there'd be a run on the banks, and so people would be pulling their money out of these investment banks. And if they're so highly leveraged like they were, and people started pulling their money out, they would quickly have no cash, no capital to pay the loans that they had to pay. And so that's what happened with Bear. And Geithner at the Fed got word of this, and he got really worried. Now he knew that J.P. Morgan, wasn't highly involved in these mortgage-backed securities and these subprime loans. So he thought, well, J.P. Morgan probably has a good balance sheet. Perhaps they could either loan Bear some money, which Jamie Dimon at J.P. Morgan wasn't willing to do. And it was precisely the reason that he didn't want to do that is the reasons why he didn't want to get involved in subprime lending anyway, was that it was risky, and he felt like he had avoided that crisis, and now he didn't want to loan to a bank who might be full of subprime loans that may not be able to pay him back. So that would suck him back into the crisis. So he wasn't anxious to do that. But when the Fed came to him and said, well, how about you buy Bear Stearns. And there had been some interest in buying an investment bank for some time at JP Morgan. They just weren't sure if this was the right time, given that they didn't really know what was on Bear's balance sheet. They didn't know how much of their balance sheet was made up of subprime loans, and that made them nervous. So, but with the prospect of Bear defaulting on some of their loans, the Fed tried to convince J.P. Morgan to just step up to the plate and buy Bear Stearns and avoid the possibility of a major U.S. investment bank defaulting on some loans. So this was sort of on a Friday when the Fed was trying to convince Bear to buy them, and they were worried that if they didn't buy them over that weekend, then when the markets opened in Asia, that it was going to be full-scale crisis mode, in the financial markets once it realized that Bear was facing the real possibility of bankruptcy. So he wanted to have a deal shored up by the weekend whereby J.P. Morgan acquired Bear Stearns. So with the prospect of potentially getting Bear Stearns at fire sale prices, J.P. Morgan did consider the possibility, and they went over to the headquarters at Bear Stearns, spent a lot of time pouring through their books to see what they had on their balance sheet, to see what these loans were made up of. But they quickly realized it was going to take more than 24, 48 hours to assess the quality of their balance sheet and the quality of the loans that Bear Stearns had. And so they balked at buying Bear Stearns. And so that news was relayed to Washington and with the Treasury Secretary and the Fed Chairman, so Paulson and Bernanke. And they came back and said, well, something's got to be done. So, and Bear Stearns stock had been selling at, like a year earlier at up to $1.30, $1.31, I believe. And JP Morgan was trying to get a fire sale price for Bear Stearns. So they're hoping to buy the bank at something like that they felt was just fire sale prices like $10, $12 a share. But when they balked at even that number, Bernanke and Paulson came back and said $2 a share. You can buy Bear Stearns for $2 a share. And at $2 per share, I think that was something like $250 million to buy the whole investment bank. And like I said, that didn't mean that the investment bank wasn't worth $250 million, because it certainly had loans out there, all these mortgages out there that weren't worth nothing. Now, a lot of the lenders might default, but even when they defaulted, there would still be an asset. There would still be a house to sell. So the loans weren't worth nothing. They just weren't sure what they were worth, right? So they may have had thousands and thousands of mortgages, and maybe these mortgages were $100,000, $200,000, and it's possible that many of them were going to default, but it doesn't mean that this $200,000 loan on this house was worth nothing, because if the mortgagee did default, the bank would take possession of the house and then sell the house for maybe $150,000. So maybe they lose $50,000 on the mortgage, on the default, but it's not worth nothing, right? But at $2 a share on $250 million, the JP Morgan was going to be able to buy the whole investment bank. An interesting anecdote in the book, they basically said that the office building that Bear Stearns owned in New York was worth more than $250 million. So anyway, JP Morgan was still even a little nervous about that, even at $2 a share, because they didn't have enough time to actually figure out what they were actually buying. And so what the Fed said was, okay, what we're going to do is we're going to take the riskiest of these mortgages, put a ring around them, and we're going to say that, okay, maybe that's $10 billion worth of mortgages that we think are extremely risky, and you don't really know how to value them or what they're worth. So let's just say that's $10 billion. We'll insure you up to $9 billion. So if you couldn't lose more than $1 billion on these mortgages. So with that type of insurance from the Fed, JP Morgan agreed to buy Bear Stearns for $2 a share. And at $2 a share, that essentially wiped out their investors. because obviously they bought the shares for significantly more than that. So they were pretty much wiped out. But that was a signal that Bernanke and Paulson wanted to send to the market was you do something risky like Bear Stearns did, and your investment's going to go down the drain. Right? So don't take this risk like Bear Stearns and be so highly leveraged that you don't have enough cash to even pay your short-term obligations. So they were hoping other banks would learn a lesson from this. So the thing is with Bear Stearns, they didn't actually default or go bankrupt, but essentially their investors got bankrupted out of their investment because they only got $2 per share. Now the price was subsequently negotiated up to about $6 or $8 a share, but at the time of the crisis, it was negotiated at $2 a share. And so it wound up being a good deal for J.P. Morgan, and it helped save sort of the day in the financial markets because now since they had agreed to do this, then when the markets, the Asian markets opened late Sunday night, which is early Monday morning for them, it was announced that J.P. Morgan had bought Bear Stearns and there was going to be no crisis because J.P. Morgan was going to make sure that they paid Bear Stearns short-term liabilities, get those paid off, and shore up the bank with capital. And so crisis averted. So even though the Fed didn't actually bail out Bear Stearns, there's a sort of perception that there was a bailout. It actually wasn't. It was sort of the investors for Bear Stearns just took the loss. And J.P. Morgan got this investment bank at a fire sale prices because J.P. Morgan had cash and Bear Stearns didn't. Right? And that's what we find out in crises. Cash is king. So you can't pay short-term debt with 30-year mortgages. You have to pay with cash. So you need to hold enough cash on hand to be sure to stay liquid so that you can pay your short-term liabilities. Now, Paulson, the Treasury Secretary, had hoped that the other investment banks had learned their lesson from this. So he basically told the other investment banks, hey, Bear was on the edge. You saw what happened to them. Basically, their investors lost their shirts, because the bank took on too much risk, wasn't well managed, took on too much short-term liability, and wasn't able to pay it. So don't be like Bear Stearns. And so with the crisis averted, there was this perception that, like we talked about before, with long-term capital management and the previous regime, that with Greenspan, that he had somehow saved the market. And there's a perception that Paulson and Bernanke and Geithner had saved the day again. And so people didn't really take the message to heart, and nothing really changed. So then what happened was some months later, Lehman Brothers comes knocking on the door, and they're in the exact same position. They got some short-term liabilities that they can't pay, too much risk on their balance sheet, and in dire straits. So they call up Paulson, basically say, who's going to come in, who's going to ride in and save us? We're willing to, take a loss, but somebody's going to bail us out, right? And Paulson was so frustrated that Lehman didn't listen and didn't heed the warnings that they had made after the Bear Stearns crisis, that he basically said, you know what, we're just going to let Lehman Brothers fail and just see what happens, and just see where the market goes from here. And just trust that we averted one crisis, and even if one investment bank goes bankrupt, it's not going to create a run on all banks sort of internationally. So let's just see what happens. So he tells Lehman Brothers, Dick Fuld at Lehman, well, tough luck. I mean, we found J.P. Morgan to buy Bear Stearns at fire sale prices, but we're not really looking to do that again. If you can't find a buyer yourself, then good luck. And Lehman Brothers said, well, we'll have to declare bankruptcy. Well, Paulson said, we got to do what you got to do. So that's ultimately what happened, was Lehman Brothers had to file for bankruptcy. And so when the markets opened in the morning, after Lehman Brothers announced their bankruptcy, the market took a little bit of a dip, but then it came back up. And people were somewhat happy in a way that Paulson didn't do anything about Lehman Brothers and just let them, just basically took them to the woodshed and let them fail. And so people were sort of happy with the self-restraint, and they just felt like, yeah, the market's going to recover, and people didn't panic. There weren't runs on banks. The other investment banks, held on. Their creditors didn't come knocking on their door. And so people were happy. But then later on that same day, Paulson got a call from AIG, and unbeknownst, because none of these things were done on markets, everything was over the counter. He didn't know that AIG had providing all of this insurance for the super senior risk on these banks' books. And so now the banks were calling up AIG saying, "Hey, we've had way more defaults than we thought. It's eaten through our cushion. The bondholders have been wiped out. We're still on the hook with the super senior debt. So you owe us a bunch of money, because you've been one insuring us." And AIG said, "Well, we never predicted mass defaults like this. We don't have the money to pay off, all of you banks, with these default claims." And so then AIG called up Paulson and said, "Hey, we're doomed here. I mean, we've been insuring these, unbeknownst to you all, we've been insuring these banks their super senior risk for all of this mortgage debt that they have, these mortgage loans that they have, and now they're making claims on us and we can't pay." And then Paulson thought, well, AIG, it's one thing if Lehman went down, but AIG is a major insurer, not just of loans, but insurance, all types of insurance all around the world. And if a major insurance provider like AIG goes down, then it will be panic mode around all the worldwide financial markets. So that's when he decided, well, he's got to do something to fix AIG. So he actually starts the process to bail out AIG. And because of this word that AIG is in trouble, then panic does set in, that maybe the world markets are fragile, and maybe banks should stop lending to each other, because nobody knows who's the next AIG, who's the next Lehman Brothers, who's the next Bear Stearns. So nobody wants to loan. And so Paulson and Bernanke recognize this. So what they do to try and avert this crisis that they see, they're on this financial cliff, because if banks stop lending, then everything shuts down. And so it's not just that if banks go under, then you're going to have Main Street companies like General Electric, if they can't get loans, if they don't have a line of credit, with whoever they have, Wells Fargo, Bank of America, or JP Morgan, if they can't get their line of credit, then they don't hold a bunch of cash. So if they can't get a line of credit, then they can't pay their employees, right? Then they have to default on employee payments. They got to start laying off employees, and then it sort of cycles through the whole economy, and people there was a lot of nervousness in Washington. In fact, if you remember, this is right during the time of the 2008 presidential election, and with McCain and Obama, and McCain said he was going to suspend his campaign and cancel the debate and go back to Washington and see what he can do to help avert this financial crisis. So what happens is Bernanke and Paulson realize that the only way that they're really going to stabilize the economy is to get these subprime mortgages off the books of the banks, so that other banks don't get stressed out, and other investors, and they'll still loan money to banks, because they won't be worried that they have these troubled assets, these subprime mortgages on their books. So what they do in Washington is they pass a bill, basically, that lets the Fed basically buy these troubled assets from the banks. So it's called the Troubled Asset Relief Program, or the TARP. And so it was something like an $80 billion deal that they allowed the Fed to use $80 billion to buy these troubled assets from the banks. That way, if they could get these troubled assets off their books, then banks would start loaning to each other again, and not be worried that the banks won't be able to pay them back, because the loans that they have, which are these troubled assets, these mortgages, are all in default. If they could get these mortgages off their books, and if the Fed could just buy them from them and get them off their books, then it would stabilize the financial markets. So that's what the Fed tries to do. Now, the Fed wasn't going to buy these mortgages for dollar for dollar. So if it was a $200,000 mortgage, and it was a subprime lender, they weren't going to pay the bank $200,000 for it. They might pay them $150,000 or $100,000, knowing that they're not going to get the full amount, on these subprime loans because people are likely going to default. But to negotiate the price, it was going to take a long time, and the Fed realized they didn't have that much time to sift through all the bank's books, figure out what they were willing to pay for these troubled assets. So eventually, what they decided to do was not to buy the troubled assets from the banks, but to buy stock in all the banks. So actually to invest in the banks. So they summoned the heads of all the banks, the investment banks, the commercial banks, the major international banks like Wells Fargo and Bank of America and Goldman Sachs and JP Morgan. So they all had to come to the White House, and they basically said, Paulson said, we're buying stock in all of your banks, and you're going to take it. And some of the banks said, hey, we've largely avoided trouble. We haven't, like JP Morgan, we haven't gotten ourselves in trouble. So we don't need the government's money. Now, they didn't want the government's money because they knew that if the government bought stock in them, the government was going to be a major shareholder, and the government could regulate what they do as a major shareholder. And so essentially, like making private banks public now, and the government owns them. So they're worried about government ownership in their banks, sort of like socializing the banks. Now, that obviously they could cut their pay, cut their bonuses, and do other things, and the CEOs didn't want to do that. At least some of them didn't. Some of them knew they were in trouble, and they were willing to do it. But Paulson knew that all the banks had to take it, because if only certain banks took it, the problem would be is it would show that those were the banks that were weak, and then it would still have the same problem because there'd be a run on those banks, and then it would still freeze the system. So he basically said, everybody's taking it. Everybody's taking the deal. And there was really no room for negotiation. And even Jamie Dimon recognizes that, it's better for us to let the government buy a portion of our bank if they're going to do it for everybody, sort of for the public good. So there's not a run on the banking system itself. So they all take the deal, and the government actually buys stock in all these banks. And what that does is it gives the banks cash, which is what they desperately needed to pay their short-term loans and to potentially loan out to, because they needed the banks to loan out to General Electric or whatever, and to honor their lines of credit with all these other companies. And if they needed cash to be able to do that, even though they had tied up too much of their reserves in these mortgages, they needed some equity back in the bank. They needed to be recapitalized. And so that's what the government does. It gives the banks cash in exchange for stock. Now, keep in mind, during this financial crisis, the bank stock's selling at an extremely low price because all these banks were troubled, and the stock price for all these banks is down significantly because the market's depressed. So the government actually is able to buy stock in these banks at extremely low prices. And sort of the ironic thing about it was because of this cash that the banks all got by the government buying stock in their bank, they were able to sort of right the ship, get their financial house in order, figure out what to do about these loans, waited for people to default, sold off the houses, got rid of these subprime loans over time. And then they were able to stabilize themselves. And then once the crisis passed, their stock price started to rise. And then over time, the government eventually sold the stock back onto the market. And so the government made a lot of money on the Troubled Asset Relief Program because they wound up buying stock in the bank at extremely low prices during the Depression in the banking system. Then once the stocks recovered, they resold it back on the market. So the government's no longer part owners in all these banks because they subsequently sold the stock, but they sold the stock at higher prices than what they originally bought it from. So they made money on the Troubled Asset Release Program. So even though it sounds like we bailed out the banks, in a sense that we did, but it actually saved us. We actually made money on the deal. Now, you think, well, what happens when the Fed makes money? Do we all get a check, in the mail? No, that's not what happens. Obviously, it just pays down some of the debt that we have. So now the bailout of AIG the government didn't make any money on that, and then subsequently when they bailed out the auto industry and other things, they lost money on those deals. But the Troubled Asset Relief Program, in the end, wound up being a money maker for the government and helped stabilize these banks. So And as Gillian Tett mentioned, sort of at the end of the book, once they bought stock in these banks, and then the banks became partially owned by the government, we'd sort of entered this whole new world of not being, of being not totally free market, because now the government actually runs banks. And we eventually moved out of that, but it started a precedent for, in times of trouble, the banks could actually become public. I mean, the government could buy into the banks. It's more of a socialist system during a time of crisis. And so I think we can see from this whole crisis that something needed to be done, right? The regulation that we had wasn't working. That not regulating these swaps and these futures wasn't a good idea. And the question is, what was the solution? And just in a summary here, there's a list of things that went wrong, and sort of the problems and the chinks in the armor of the system. And it was, the regulators who had this free market ideology that they eventually had to abandon, right? These bankers, they're being too innovative, and they're creating these deals that were extremely risky. The credit rating agencies, and similar to the auditing industry, where the client pays the auditor, but the auditor is supposed to protect the public. It was the same with the rating agencies. The rating agencies are supposed to represent the public, to tell the public what are good investments and what are bad investments, but they're being paid by the banks to rate the bank's investments. So rating agencies, like I mentioned, serve the hand that feed them. Regulators weren't doing enough because they believe in the free market ideology, this efficient markets hypothesis that the market can regulate itself. And there was this assumption back then that why would a bank put itself out of business? Why would a bank do something as risky as Bear Stearns did? Because, the public, and regulators have less of an interest in making sure that Bear stays afloat than Bear itself does. So why would the folks that are managing Bear run their bank into the ground? Well, the problem with that thinking is the owners are the managers at Bear Stearns. They're not Bear Stearns themselves. So Bear Stearns is made up of a bunch of individuals, and the individuals, they have an incentive to take on more risk than the company could handle, because they're the ones that get all the rewards. But if the company goes bankrupt, they don't give back their salaries; they just find a new job. So if they run Bear into the ground and take on too much debt, and then subsequently Bear can't pay it back, well, during the good times when they were so highly leveraged that they were getting huge returns on their equity, during those good times, they reap huge returns and huge salaries. And the bad times, they don't have to pay it back. The Bear Stearns goes bankrupt, and those managers just move on to some other jobs. Right? So the free market ideology doesn't necessarily always work, right? Which is what we found out. And there's just a lot of other chinks that were in the armor, because homeowners, for example, they have a call option in a sense that we all do when we have a mortgage, because if interest rates go down, we can refinance, right? We're not stuck with the loan forever. So we can always refinance whenever interest rates go down, and if it goes up, then we hold on to the mortgage, right? And bankers sort of have that same. When they put those mortgages in CDOs, they can always call those CDOs, and so there's just a lot of chinks in the armor. And what we see from this whole crisis is that if we don't shore up the banking industry, and I mentioned on page 184, just like consumers who panic during a food poisoning scare and stop buying all sausage or burgers overnight, investors could not tell exactly where the rot had ended up. So they stopped. It stopped banks that had this rot on their books, these subprime loans that people were defaulting on. Everybody just stopped investing in those banks, right? Which is what happened with Bear Stearns. So there's a central run on the banks, and so what we find is that when even a few banks get themselves in trouble, it creates worldwide financial chaos. because banks get nervous to loan to each other. And when that happens, we get into a lot of trouble. And so we've always sort of had this arrangement where, in the U.S. and in Europe, that banks were going to be private, but we're going to heavily regulate them, especially commercial banks. And so the European bank executive, page 244, after the Troubled Asset Release Program, and then the things that European banks were doing, they said, we're moving into a world of socialist banking where the government can meddle wherever it wants. Well, yeah, that was somewhat true because the banks got themselves in trouble and the government had to step in. And so consequently, like in the Wall Street Journal mentions in December 2009, that the UK Treasury chief, like the Paulson equivalent, announced a one-time 50% tax on bonuses in excess of £25,000. So they were taxing bonuses because they were like, hey, you guys are the ones causing the problems. So, you should be giving yourself large bonuses. So what Ted talks about is what's not the solution is to depend on banks just to do the right thing. We found out that didn't really happen. And again, it's like I said, it's because banks are run by individuals. They're not. There's not a bank itself that's making the decision for this. It's not like the bank's a person. There's a bunch of individuals who all have different incentives to do different things, and so we can't rely on those individuals who are trying to maximize their own profits to think about the worldwide financial markets. We need a regulator to do that. So some blame the problem on a dire lack of financial statesmanship, or the inability of banks to think about the public good. Well, yeah, we can't rely on individuals at banks to be thinking about the worldwide banking system. We need regulators to do that. Right? We need a Treasury Secretary. We need the SEC. We need somebody who thinks about the worldwide system itself. And so, hopefully the government can take action to align the incentive of banks and borrowers with that of the public good. But we're still not quite sure how to do that. Just like during the times of when we read in the number during the late 1990s, early 2000s, when the market fell apart, we created the Public Company Accounting Oversight Board. Right, we always created a government agency. During the financial crisis, during the Depression of '29, right, we had the Securities Act of '33 and '34. We created the Securities and Exchange Commission. Well, we did the same thing, and the crisis in 2008. We passed new regulation, the Dodd-Frank Act, and that created the Consumer Protection Agency. So we always create a new government agency. But what we never do is step back and ask ourselves, we had regulation, right? We had an SEC. We had commodities regulators, right? We had regulation in place. The question is, why did the regulation that we had work? And so rather than just keep the same regulation that wasn't working and then add more regulation, the solution is probably step back, think about the theory of why things are falling apart, revisit the efficient market hypothesis, this free market paradigm, and think, okay, well, that didn't work, right? The SEC regulation, what are their incentives? Why are they not regulating this? Why are things falling through the cracks? Why do we pass these laws that said we couldn't regulate swaps and futures, right? So maybe we need to step back and say, okay, let's unwind the regulation that we have and put real regulation that works in place. And that's what we need to do. And we still haven't found that yet. I mean, the Dodd-Frank, the purpose of that act is what they said was that we're going to try and make it so that banks don't become too big to fail. But because of all the regulations, small banks are the ones that failed. They couldn't keep up with the regulation. You need economies of scale to be able to afford the overhead that the regulation brought on by Dodd-Frank. So small banks had to get acquired by larger banks so that they could meet these regulatory reforms. So now the problem is that that we still have banks that are the same size. Like they haven't gotten smaller. They're not less big than they were before, they're still too big to fail. So we haven't really solved the problem because we never step back and think, what are the incentives of the bank managers? What are the incentives of the regulators? How do we align those incentives so that it matches the public good? We just keep adding layers and layers of new regulation. Now, regulation we need, but what we need is effective regulation. And it's important to read this book for several reasons. And just like it was important to read the number, we can see, even though during the crisis of 1999 and 2000, we saw a whole bunch of people go to jail, right? So we had HealthSouth, even though Scrushy got off, he eventually went to jail. We had Kozlowski, Tyco go to jail, Bernie Evers go to jail, Kenneth Lay at Enron, even though he died before he went to jail. But Skilling went to jail, Fastow went to jail. The Regas family with Adelphia went to jail. So there was a lot of fraud that was uncovered. We didn't uncover as much fraud per se and prosecute people during this last crisis. But that doesn't mean the fraud wasn't there. It's just that it's extremely difficult to prove because you have to prove intent. So like with the managers of Bear Stearns, should they be held criminally liable for creating this maturities mismatch at their firm where they were getting short-term loans to buy long-term they were getting short-term debt to buy and to issue that money out as long-term loans for mortgages. So, and they were too highly leveraged. They got themselves in trouble. Was that criminal, right? And that's hard to prove. Like with Lehman Brothers, there was talk about criminal prosecution, even of their auditors, even of Ernst & Young. But eventually the Attorney General in New York backed off on that because it's hard to prove criminal intent, that somebody was criminally negligent or criminally did things that were, things that were criminal. They weren't just bad business decisions. So it's somewhat hard to prove. And so we didn't put a lot of people in jail, although there were a lot of people who did go to jail. There were loan originators who were just pushing loans out, right? So there was a lot of lender fraud. Even Lehman Brothers, the bankruptcy court came out and said, yeah, it looked like they were committing financial statement fraud, even though they took on too much risk. The pressure that they were under to show that their debt was under control caused them to do those Repo 105 transactions and hide their debt on their balance sheet. So their fraudulent financial reporting is what they wanted to criminally prosecute Lehman for, even after it had gone bankrupt. They wanted to criminally prosecute the managers at Lehman and their auditors and Ernst & Young. And so you can see by reading both these books the pressure and the incentive to commit fraud. You can see the opportunity that these managers have to commit fraud. And then it's also the ability for them to rationalize. Right? So a lot of bankers don't need to rationalize because they don't care. They can do the wrong thing, and not feel bad about it. But most of us feel bad about it when we do something that's unethical or criminal. But if you think that you're just doing what everybody else is doing, right, and every bank was doing the same thing, and if they can justify that, I'm just doing what everybody else does, right, and if I fudge around the edges with my financial statements, there's no harm done. I'm just doing what everybody else does, and I'm protecting my investors. Right? And so it's easy to rationalize. So reading Fool's Gold and The Number help you see the pressure/incentive that people have to commit fraud. You see the opportunity that management generally has to commit fraud, and then the rationalizations. Right? And to think that this type of thing's not going to happen again is naive. It's going to happen again. It's going to happen again in a different market. So we moved from the high-tech stock market that crashed, and then there's a lot of frauds there, to the real estate market because everybody's looking for high yield. Everybody's looking for the next big return. And it's just going to move from one thing to another. And collectively, we all tend to look the other way when everybody's making money. Right? And so it creates an opportunity for people to commit fraud. And so you can easily see through both of these books the pressures that get to people, the incentive that they have, and when incentive and pressure are high, and you have the opportunity to do something, all you have to do is rationalize it, and then you've got a fraud. So hopefully the fool's gold wasn't quite as easy to read as the number, but hopefully through the slides and the discussion, it was equally as interesting, and you learned a lot from it.